So we have a little bit of an idea about markets, how they work, and we have an idea about the cost structure of firms. Now we're going to move to what we call comparative market structures. It's not as complicated as it sounds. We're going to start out with two baselines. One baseline, this chapter 7, is what we call competitive markets or perfect competition. Second, we'll look at the other extreme, which is called monopoly, and then we'll look at the two market structures in the middle and the ones that are a little bit more realistic. We use perfect competition and pure monopoly as baselines, kind of to compare. It's kind of a baseline for comparison of the outcomes in the market structure. So what we're going to look at is the characteristics of a competitive market. We're going to look at the difference between the firm's demand curve in a competitive market and the market demand curve. And we're going to talk about the long-run decision-making and the consequences of long-run free entry that we'll see as a characteristic in perfectly competitive markets. So the three main ways we differentiate markets is by the number of firms and kind of what kind of product they produce and how easy or difficult is it to enter the industry. So the perfectly competitive market, remember, this is perfectly competitive. It's kind of ideal. There's probably not really perfectly pure competition. We have industries that are more competitive than others, and we'll talk about that as we proceed. But the perfectly competitive market will have a large number of small firms, and so it's kind of what kind of number is large and what does small mean. These are kind of arbitrary, so we need to make sure that we say what we mean by a large number of firms or a small firm size or something like that. We say a large number of producers means that no single producer is able to impact the market price. Remember, we looked at the things that influence the supply curve, and we said if there are more sellers, that shifts the supply curve to the right and pushes price down. And what we mean by this is there are so many firms, there are so many producers in this market that as one firm enters, it's not going to move the supply curve enough to affect the market price. If one firm leaves, it's not going to affect the market price one way or the other. So there's so many firms such that the market share of each firm is so small that they're not going to be able to impact the overall market price. So we mean these firms are small relative to the market. Small in the sense that they're changes in production decisions, or the idea that they may decide not to produce at all, is not going to affect the market price. So we have a large number of small firms in perfect competition. These firms are producing a homogeneous product, or homogeneous product. You know, the idea of homogeneity is that they're all the same. Another way to say it is that the firms are producing things, they're producing goods and services that are perfect substitutes for one another. That is, the buyers are completely indifferent between buying from one seller or another seller. We think of some things that are good substitutes, like Coke and Pepsi, but some people will say that they always prefer Coke over Pepsi, or vice versa. That the idea that Fords and Chevrolets trucks may be good substitutes for one another, but we know that there are some people who would say that they would never buy a Chevrolet and they always buy a Ford, even though they're both producing pickup trucks. So, right, there are some things that are reasonable substitutes, and there are some things that are perfect substitutes. So we oftentimes, when we think about competitive markets, we use agriculture as an example, because these things like wheat are sold in a commodities market, and the buyers are indifferent between farmer A's wheat and farmer B's wheat. That the wheat that they produce is of no better or worse quality, And so that the buyer is completely indifferent between the output from the different sellers. So we say that they're perfect substitutes for one another. And then there is very easy entry and exit into the market. That is, ideally, in pure perfect competition, entry and exit is completely free. We also should throw in that there is free in what some economists call perfect information. That is, everybody who's participating in the market knows everything about the market, so that you're not able to trick people into paying a higher price than the market price, because everyone knows everything. So the information is free and easily acquired. And so when we look at this market, the market supply and demand is shown on the left. So this demand is the market demand, remember, is the sum of all individual demand at all prices. The supply is the market supply. It's the sum of all individual sellers' quantity supplied at all prices. So we see that the demand and the supply intersect at that price of $70, where the quantity supplied is equal to the quantity demanded, where the two curves intersect. And so we see that the market price is $70. So what the individual firm faces, we said that there's a large number of firms such that one firm cannot affect the market price. So given the picture on the left where the market price is $70, each individual firm sees a demand curve that is perfectly elastic at the market price. That means they can sell as many units as they are willing to produce and offer for sale, as long as they offer them for sale at that price of $70. If they try to even charge $71, they won't sell any. If they even try to charge $70.01, they won't sell any. And the reason for that is that if there are many, many producers, then the buyer can always find a producer that is charging the market price. So if someone tries to charge above the market price, remember the perfect information, we can't trick them into paying more than $70. And there's also no reason for them to charge less than $70. They don't benefit from lowering their price because they can already sell all that they want to produce and offer for sale at that market price of $70. So we call all these perfectly competitive firms price takers. So even though the market demand curve is downward sloping, the individual firm faces a demand curve that is perfectly elastic at the market price. If we look at the firm's cost curves, so we have the marginal cost curve here that's in red. We have the average total cost that is here in green, and the average variable cost that is in blue there. The competitive firm wants to maximize profits, and they do so by producing the quantity at which the market price is equal to the firm's marginal cost of production. That is, where the market price is going to be the same as the marginal revenue of the firm, because they're selling all of the units at the same market price. So in this graph, we look and we see some points labeled A, B, and C. These are special. One of the things that is consistent is that the marginal cost curve intersects the average variable cost curve when average variable cost is at its minimum. So this minimum average variable cost is, for this firm, $30, but this minimum average variable cost is where these two curves intersect. That means that this firm will continue to produce output in the short run as long as the price, the market price, is $30 or greater. Now notice that the average variable cost is below the average total cost. That means even in the short run, this firm would be incurring a loss by choosing to produce. The idea, though, is that the firm can minimize its losses by choosing to produce in the short run rather than shut down. So we can imagine that this is a price that allows them to pay all of their workers and all of their variable inputs, and also maybe pay a little bit on the rent that they're going to have to pay anyway, even if they choose to not produce. It's something like the fixed cost, right? And so point B is special because marginal cost intersects average total cost when average total cost is at a minimum. So this is a special price because $45 for this firm is where the firm is going to earn a what we call a normal profit, or profit, an economic profit of 0. This is where the market price, which is the marginal revenue for the competitive firm, is exactly equal to minimum average total cost. So this point B is a special point because it's where the firm will be earning a 0 economic profit, but it will be in the firm's best interest to stay in business here. A point like point C, so at a price that exceeds $45, we can look at this one, the price of $90, that means the firm's marginal revenue is $90, so their revenue increases by 90 every time they increase their output there. This profit maximizing level of output in this case would be 10, and the cost well exceeds the average, or the revenue greatly exceeds the firm's cost of production, so this firm will be earning positive economic profits. This firm will be earning positive economic profits if the price exceeds $45, just looking at $90 for an example. So let's think about the idea of profit maximization. The firm's profit is equal to the total revenue minus total cost. It turns out that the firm can maximize its profits by choosing the quantity of output where the marginal revenue is equal to the marginal cost. A little bit of intuition behind this is that if the marginal revenue exceeds the marginal cost, that is, revenues are growing faster than cost, that means the profits are going to be rising. Alternatively, if marginal cost exceeds marginal revenue, the change in cost is bigger than the change in revenue, then profits are going to be falling. And so logic tells us that if it's going to be rising in one instance and falling in the other, then it must be the case that when marginal cost is exactly equal to marginal revenue, profits are at a maximum. We'll talk about this again when we look at the monopoly. What's special in perfect competition is that there's free and easy entry into and exit from the business. So if we have a situation like this, where the market price is at $90, if the market price is at $90, then existing firms, who by the way have similar cost structures, are going to be earning positive economic profits. So what we expect is that entrepreneurs recognize that firms in a particular industry are earning positive economic profits, and entry into that industry is free and easy, then they will devote their resources to production in this industry. If a bunch of firms enter, if many firms enter this market, then it's going to push the market price downward. So what we expect to see, if the price began at $90, new firms would enter, the supply curve would shift to the right, pushing the market price down until it got to a price of $45, where the firms would be earning a profit of 0, or what we call a normal profit. Alternatively, if the price were below $45, something like $30, firms might choose to produce in the short run, but in the long run, they're going to exit. Remember, it's easy for firms to get out of the industry. Firms exit the industry. All the firms that are not profitable exit the industry. The supply curve shifts to the left, and the market price rises until we get to this same point B, where the market price would be $45. So that in the long run, because of we're looking at long run entry and profit, because entry and exit is free and easy, the long run price will be equal to the minimum average total cost. And that means that all firms are earning an economic profit of zero, which is, if we go back to our former example, when we talked about explicit and implicit cost, if you remember, we talked about a salesperson who was earning $50,000 who began earning a positive economic profit in the restaurant business. Now, when new restaurants enter, his economic profit is going to go down until he's earning that $50,000 over the long term. He'll wind up earning exactly what his opportunity costs were before. So take a look back at that and think about how entry and competition pushes prices down and makes it tough for the firms in the industry, but that competition turns out to be good for consumers, right? The competition results in low prices, and by the way, competition for the consumer's business should result in better products and service. Next, we're going to take a look at Chapter 8, the monopolist.